So now we'll turn to refined products, and we'd like to remind you, please like, share, subscribe. Your support is appreciated. And if you have any questions, please let us know. Anything you want us to see us cover more, less of, we always love to hear your feedback. So now that when we look at just where things are, and again, this is always when we look at gasoline, jet, distillate, and residual, we always like to see what is happening in general on those moving, what does mobility look like? And you can see that, on the current side, we're hitting at about 14.568 million versus last week, or the week prior, of 14.092. And the average is coming in at about 14.4. So as you can see that when we look at 17, 18, 19, those normal, quote unquote, normal times, or as I like to call the before times, we're typically at 15.3 to 15.7. So we're about 1 million to 1.5 million below that average, and just based on what we're seeing coming forward, where distillate's going to come back a bit, gasoline will stay stronger, but again start to normalize a bit lower. Those things are going to keep us capped closer to that 14 million barrel a day level. And just as we start to go through the next few weeks, jet is going to start to, like we said, waffle kind of between these levels, and then distillate is going to be the one that's going to have some of the biggest shocks up and down, especially with some of this cold hanging over in large parts of the U.S., which we'll talk about in a few minutes. So again, when we turn to distillate, so distillate had a nice draw of 2.08 million. We're still 14.5 above the year over year, 4.7 million above the 5-year average, but we're starting to see some of that whittle down, and we're starting to see those imports. As we were saying, imports are swapping. So where we had a big increase in imports of distillate, we're now seeing big increases in gasoline. So we're starting to see some of this normalization. It declined 64,000 barrels a day, which is 52,000 barrels below year over year, but still 82,000 above the 5-year average. So even though we're seeing a slowdown, we still have some residual. We're still going to outpace the 5-year average, but we're just going to start to see some of this normalization. And as we've been talking about, we normally see this drawdown that starts to slow down and then stop in April, as we go through April into May. So even, we're supposed to see draws right now, and here we're just kind of competing back and forth as you have refiners that are adjusting what they're producing. So when we look at yields in general, so when we look at gasoline yields, so what are the refiners trying to do? They're trying to make more gasoline. So here you have an increase in production of about 256,000 barrels a day of gasoline, and you only have an increase in production of about 4,000 barrels out of distillate, because again, they're trying to target that lighter end where when we look at blending stock as well as gasoline, to try to avoid some of this distillate, just because we do have enough distillate in storage, trying to get some of this storage down while trying to build up gasoline, because again, it's just going to be a matter of where do you see some of that growth. And just looking at the average over the last 29 years, this is typically what happens this time of year, just because they start to prepare. We're April 14th, your Memorial Day kicks off driving season. So again, they're just doing things that are normal on a seasonal level, just at a marked, step down in terms of where they are normally. So then when we look at demand, as we've been talking about, so we had a counter seasonal bump. You can see that it all is a matter of timing as to when we see these pops. Typically it happens a little bit later in April. Instead, it happened here, but we're still averaging close to what that 5-year is over the last few weeks. It's just a bit more of a W shape versus something a little bit flatter and then to the downside. So again, it's just going to be a matter of when does this product go out, when does stuff start to come through, and we're just seeing some of that normalization. And speaking of normalization, when we look at truck stop, you're starting to see some of this pull back, but even though we've pulled back to, the demand index of it at 160, we're seeing some of that load availability creep back up. So which is going to support, again, some of this demand, because we do have loads coming back. but we continue to see rates pushing higher. And again, that's leading to, that's just because what we're seeing with diesel, where diesel prices continue to drift higher, and we continue to see load availability, which again, there's just a matter of competition as to who's going to get this. So when we look at the demand index, we're still going to stay very strong, especially as we look to close the gap when we're looking at what is happening in inventory, what's coming on shore, because typically this is a seasonal slow period for imports, and we're just blowing through all of that, especially when we go through the what's happening on the coast, what's happening with rail, and obviously what's happening with trucking. So speaking of rail, when we look at the movements, and I just laugh because you're starting to see those year-over-year issues when we're looking at those comps from 2020. So when we look at those increases, motor vehicle and parts are up 450%. The one that we're seeing that is going to continue to be fairly strong is obviously going to be grains. We continue to see those exports being fairly strong. Petroleum and petroleum products are starting to pick up a bit, and that's really just driven based on what we're seeing on the level of just movement into key markets, like moving blending components, moving things. So that's something that will actually be a little bit of a bright spot, especially against over last year. But we typically start to see a bit more movement as refiners and facilities try to prepare for what they know is going to happen over the next few months, just for driving season, obviously. So that's going to be a positive. And then intermodal continues to be strong. And that's something that's going to remain the case, just because, again, we're looking to get some of this capacity into the system. It's obviously a bit skewed here. It's something closer to upper low to mid double digits. We were initially thinking 7 to 8%, but right now it's much closer to 12, 14%, and it's something that's going to remain elevated in general as we continue to see total car loads pick up as we're again trying to manage this supply chain that remains undersupplied. And then when we look at what's coming into the port, typically March into April is a fairly slow period, and then we get this increase as we go into May. But we still have that backlog on the coast, and as we've had that reopening on the level of Pad 5, especially California, we're trying to get some of these cargoes off ships into the supply chain. So again, even though we've normalized versus this 180, 200,000 import volumes of TEUs, now we're closer to 130, 160, but when you think about where that normally is on a year over year and just in a normal time period, we're still far over where we should be, just because the slowdown is in just exports into our imports, and is just creating this bottleneck that, again, we're trying to work through. So the normal slow period is just getting smoothed over. But hopefully as we get into, as we go into late May and June, when we normally start to see this increase, we'll be closer to normal, which again will start to ease some of those issues as we look at what's happening on the coast. The problem is, and we'll talk about this in the econ show, a lot of this pricing continues to drive higher on a PPI level. And again, those are things that are going to be a catalyst for inflation as we continue to see pricing move higher. Now, this is what we were talking about with some of the shifts. So if you remember from last week, there was an expectation that April was going to be a little bit warmer, or at least seasonally normal or a bit warmer across, large parts of the U.S., as we got into the, from here into the end of April. But that really shifted. So now we're seeing a fairly sticky cold that is holding over Texas. I don't know if people saw the ERCOT warning in terms of, this cold that was unexpected, but we're seeing that really push through large parts of the U.S. up and through the north and then across into the east, which is going to keep some of that demand for propane and heating oil a bit longer, and especially on the heating oil side, which again we saw some of that pull through as facilities planned or prepared for this shift in weather. So again, this is something that also proved to come through in these diesel numbers, especially, or I should say heating oil numbers, which again is diesel at this point, is really pulling that through, which we saw come through in the demand numbers. That will start to normalize a bit lower. But again, still remaining elevated just because this is going to again, then draw down people's at-home heating supply, which will then get refilled. So it's just a nice little bump into the end of heating season. Now, on the gasoline side, we had a small build of 310,000 barrels. We're still 27.3 million off of the year over year, and now we're about 5.8 million off of the 5-year average. So the year over year comps on the builds is going to get tough just because we had a very big surge in essentially the no one moving anywhere, which put a lot of gasoline into storage. So it's good to look at the 5-year average, and we'll look at that in other slides and pictures just to kind of show what that looks like. So typically, we continue to see, when going over the last 29 years, we typically see a drawdown into essentially early May, and then we flatline a bit, and then we start to see some of that demand come through as we get into driving season. But we're starting to see that shake up a bit, and as we were saying last week, we expected to just go flat, where we weren't going to get a huge amount of a big draw. We weren't going to get a big build. We were just going to flatline because we did see that last, that pull through on the demand that was going to pull stuff out of storage. Because when you look at Gas Buddy, Descartes, some of these leading indicators, they're showing you what's happening at the pump. And this is a little bit further back, where when you think about, you have to draw down the pump. As the pump, gets drawn down, an alert goes off, and then they pull down from the rack because they have to pull down from the rack to refill the pump. And then as the racks get pulled down, it comes out of storage. So again, this is just looking at what we're seeing through the supply chain. So that's why when we saw these nice numbers, or these strong numbers coming out of Gas Buddy, Descartes, that was going to pull through, but we had a lot of imports, which was, again, going to offset. We also have refiners that have increased runs of gasoline, which was going to offset. And that's where we're seeing where we're going to drift higher. But again, it's just going to be a battle back and forth to see how big are those builds. And it's going to be a matter of how strong is that demand. And again, as we've been saying, that demand is going to start to slow down, which is going to put a bit more into storage, especially as we had some of these delays on imports, and we had some, and we do have an increase in runs on the U.S. side. So you keep talking about imports. Imports were down 457,000 barrels a day. And in Pad 1, they were down 545,000 barrels a day. But we have to put that into perspective. So even though we were down 457,000, year over year, we're still up 437,000. And on a 5-year average, we're still up 137,000. So it just shows you how big that spike was. And now, again, this timing delay that we keep talking about, and because there was so much, we had this backlog. And now this backlog is starting to clear, which is going to maintain this level of imports, which again is going to offset some of the demand. And as we get an increase, because as I said before, the yield on production increased 256,000 barrels a day. So we have an increase in refinery yields of gasoline. We have an increase in imports, and we continue to see exports being lackluster, which again is going to keep some of the storage elevated. So we're going to get some of that competition back and forth. Now on the blending component side, we actually had a nice drawdown of 1.4 million as we're starting to see some of the blending increase, again, speaking to the adjustments at the rack, because it just means that we had some nice drawdowns, and then you had that replenishment coming from storage into the racks because you saw an increase, whether that be plus, premium. For those that look at the pumps, you can see that the spread between, the octane spread remains very healthy when you look at regular versus premium. So that's where we sit in general. But on the blending component side, we're only 4.1 million barrels a day off of the 5-year average. Again, these are things that we think are going to close that gap. And if you remember earlier, it doesn't take a lot to close that gap, as we saw at the beginning, at the end of January into February. It's just we're going to get stronger demand than those points, so that these builds will be a bit slower, which will adjust that slope in general. So when we talk about the Gas Buddy data, here's the visual that they created. So this is something that we were talking about where we're going to get this nice move up for Easter, spring break, and then we're going to start to cap a little bit, crest, and then come down, which is why we think there's a little bit downside left. But again, we're not coming to where we were for 5 weeks ago. It's just going to be a little bit lower as weather gets a little bit warmer. The cold is going to eat into that a little bit in terms of what activity people are going to do, going to parks. But again, people want to go to parks. They want to get out. I'm sure parks near you are crowded. I know by me they've been a bit more crowded. So let's just put numbers around it. So for the first time in 7 weeks, weekly demand fell. According to Gas Buddy data, U.S. gasoline demand fell 0.9% last week due to the prior week seeing Easter travel. And then let's look forward now. So according to Gas Buddy data, Monday U.S. gasoline demand fell 4.2% from the prior Monday, but was still 1.6% higher than the last 4 Mondays combined. So again, that's what we're seeing. We're just going to keep walking lower, but we're still going to be setting, above that 4-week average because of these, week, the end of Feb into the beginning of March. And we're just going to work and be somewhere between, let's call it March 1st and March 14th. We're going to start to work closer in that middle lane as we start to see some of that normalization. And then looking at Descartes, gasoline demand fell 1.2% to 9.3 million barrels a day. As we've been saying, they've always been a bit over. But again, we're seeing the same trend to the downside. And but it has still increased 1.8 million barrels a day from the Texas freeze-off in mid-February, which is why, again, we're starting to see some of this stabilization just at a slightly lower level. So then when we look at pricing, so the year ago is going to be a little bit tough. It's going to be better to look at the week over week because year ago is obviously up. We're almost $1 where we were a year ago. Obviously, that was peak COVID lockdown. So that we just saw a huge drop in pricing. But week over week, we're pretty much flat. And just based on where crude is right now, WTI is sitting at 63.17. We expect to see this continue to creep higher. And it's going to get closer to probably about $2.87. So we should see maybe another penny or 2 pennies up. And that's going to keep creeping as we get into those summer months. As we keep talking about summer, gasoline is inherently more expensive because of that octane, because you have to make it differently, because you can't use benzene at the same levels or at all, depending on your location. So again, that's going to just makes it more expensive because benzene is cheaper than its replacement. Then when we look at diesel, is down about 1.5 pennies from a week ago, holding at about $3.13. Just based on, again, pricing that we're seeing in the market, we just think that we're going to get back about 1 penny. So we'll start to see a little bit of an increase week over week. But again, we're pretty confident that on a diesel side, we're going to start to see a little bit of a stabilization where gasoline is going to inherently start to creep up, just as, again, as we're talking about just how they're made and how the adjustments are. And that's another reason why you're going to see refiners increase their runs because, hopefully you can make a better margin. Then when we look at blending components in general, we're still at the 29-year high. This is a bit misleading just because obviously blending levels have changed. The requirements have changed. So you just inherently have blending levels, which is why that 5-year average is better. And we're starting to see it move closer to those normal moves. But when we look at 2021, we're moving fairly stable, sideways, again, as refiners continue to push for those levels. When we look at the 15-year, we're right back to the 15-year average when we're looking at just, gasoline demand, which is, again, a little bit misleading just because, gasoline demand has been incrementally moving up essentially every year since 2006. So it's something when you look at the average in general, which is why we just want to show that we're not crazy. We're still moving in a very steady fashion. We're back to some of that 15-year average, but then we want to look at what does that 5-year look like. And you can see that we're right back to those highs for 2021. But as we've been saying, we're going to fall back a little bit. So when we look at that 5-year average, you can see that, again, we're still below where we should be as 19, 18, 17, 16, over the last 4 years. But when we talk about it coming, normalizing and coming lower, we're not saying that we're going to get to this March 14th low. It's just we just think we're going to work much closer within a tighter band. So we're going to probably set a lower low, but not by a lot, because if you see here, we just think that we're now going to go sideways and make let's call it a chevron pattern going sideways, where we'll have come closer to the high that we set here, come maybe a little bit lower than the low that we set last week, and start to work through. Depending on how cold it is, depending on what activity looks like on the weekend, we could see this pull back a tiny bit. But again, we're just gonna, in our view, go sideways at this point with a slight average, bouncing back and forth. On a propane side, we're starting to see some of this normalization that we normally see. The spread has opened up into Japan, so we're actually going to see an increase in exports over the next few weeks. But when we look at the kind of that normal level, builds were about 1 million barrels. And you can see on just the seasonal chart over the last 5 years, we're obviously at the low end of that seasonal chart, but again, we're starting to trend, back to where we normally are. On the just looking at U.S. activity in general, you can kind of see COVID cases have started to increase a bit. That's something that is fairly stable, just because even though we're getting a increase in some cases, it's really location based. It's not a widespread increase. We continue to see vaccinations accelerate, which is something that we're going to talk about. And again, these are just net positives. It's just the lockdown index is, as we were saying, it's just not going to get better. It's not going to get worse. It's just going to stay at this level at about 55 to 57 when we look at the stringency index. So again, this is just going to be pretty much a solid state going forward, which is going to offset maybe a little bit on the restaurant side and on the retail side, but again, not too much on going to parks and being outdoors. So the data didn't update for Dallas Fed, so mobility. So we'll talk about this on Friday. Just wanted to reiterate kind of that difference between where things are happening right now. And then when we break it down based on sector, the biggest driver on some increases has been the West Coast. And as we were saying, that nice little spike up was really where we saw some of this demand shift. But now we're starting to see that flatten out. Again, not coming down, just flatlining, which again is just going to keep some of this fairly capped on the mobility side. And when we talk about capped, this is what we're talking about. Here you can see parks continue to trend up. Anybody who's been to a park can attest to the fact that is the case. And we're starting to see a little bit, on that flatlining on workplaces. Transit stations are seeing a little bit more activity. Workplaces, again, not seeing much, which is why we keep talking about weekday versus weekend. And then when we look at retail recreation, that is flatlined. Pharmacies continue to be the driver because they are the ones that are administering the vaccine. So it's not surprising to see some of that residual increasing. Then when we look at transit ridership, you can see that Los Angeles is shifting up. You're seeing more people taking buses. But, LA never really fell to the same level, where when we look on the national side, the change has been fairly flattish. It's increased, but by no means where we would hope it is. And as people are opting to drive, we are getting more transit as there's more vaccinations. But again, this is going to be that slow grind back up, especially, and I think it's going to take people sitting in traffic to say, what's worse, traffic or sitting on the train, which is still going to be not as crowded, just given the amount of people still working from home. So again, this is something that will continue to trend up, but just not at the same level, especially when we look at like New York City. And I still have a ton of friends that anecdotally, just based on where I am, that still continue to work from home. So on the Apple Trends level, we're pretty much flatlined here. You can see the increases that were driven based on Easter, spring break in the U.S. The UK is showing some signs of life, as we are seeing some of that increase in general. But then when we look at Germany, Italy had that marked that shift down as they increased lockdowns and curfews. France, Belgium, something similar. Belgium is now talking about getting rid of their lockdown in beginning of May. Germany has agreed to extend it and to increase it just based on what they're seeing there. So again, This is, on a European side, we continue, or I should say mainland Europe, we continue to see something hold below the baseline. The UK is going to be right on baseline, with the US maintaining about, let's call it 10 to, I should say 15 to 20% above baseline, just given where the activity is in general. Now, when we talk about COVID cases, this is what we're referring to. Asia Pacific is the one that we were talking about, of seeing the hit to demand as India continues to see an acceleration, setting new highs on new cases, even as vaccinations accelerate. But when we look at Brazil remains elevated. France has now shut down travel from France to Brazil. It'll be interesting to see if others follow suit, especially out of Europe. But India and Asia Pacific continue to be the biggest issue, because obviously India and Asia Pacific are the charts look exactly the same. It's just their Asia Pacific has a bit more as Malaysia is increasing. When we look at South Korea, it remains elevated. Same with Japan, as France and Germany continue to drive a bit higher. Now, when we look at the U.S. continues to move up. We're now at 1.01 vaccinations per 100 people. We were initially last week at 0.9. Again, moving in the right direction. Little hiccup with J&J with the pause due to the rare side effect of blood clots. And again, these are things that we think will be worked out over the next few weeks, or I should say days. And I don't see that impacting the U.S. all that much when we're looking at the increase in vaccinations. Germany has started to accelerate at 0.6. China and India and unfortunately Russia remain at the low end of that scale, which again is going to eat into not only just some of that Russian demand, but also that Asian demand, as Russia continues to increase exports of crude, because they're just not seeing the demand locally, and that's one of the big reasons why. Now, shifting to jet fuel here, jet fuel had a draw of about 1.28 million. We're about 3.3 million below year over year, 4.8 million below 5-year average. So not too far down, but we're also seeing a little bit of increase in yield from the refinery side, which could be that move of just separating it out from the kerosene from the distillate pool. So again, not too much change. This is one that we actually think will have a little bit bigger drop to closer to about 1.2 million and hold a little bit closer on an average to 1.1, 1.2, because we're not seeing a huge change in general in terms of demand, which is what we're seeing here. So there was a small increase of 280 flights on average, but they were driven by China, Saudi Arabia, and Canada has started to slow down that a bit with some of the additional lockdowns. So, but China and Saudi Arabia are something that we'll think will stay fairly sticky. And here's where, when we look at North America's flatlined, Asia Pacific is flatlining and actually starting to roll over, because even though China's increasing, we're getting some decreases from the rest of Asia. And then when we look at the rest of the world flatlining, Europe is seeing a little bit of a recovery, and we'll talk about that in a second. So in Europe, Germany and Italy led growth in departures. Flights in the Eurocontrol area ticked up modestly week on week by 4%. Increases in departures are below the levels of seasonal growth expected at this time of year. So it's important to understand that we normally see increases in Europe right now. It's just happening at a very at a much lower level, because you do normally have spring travel and tourism, and you're just not getting that obviously this year. So even though we're seeing an increase, it's still far below where it should be at this point. So, and as BNF describes, with the beginning of summer travel season, likely to see fewer flights, pent-up demand may lead to higher levels of departures in late summer, as occurred in 2020. So they're preparing to increase in the end of summer, but again, we're not seeing that right now as things hold fairly flat. And this is what we were talking about with TSA passengers, where we had that normal seasonal bump, as you can see, between the yellow line and blue line. And now we made that lower low versus the last 4 weeks. It's just, we're not going to go much lower. We're not going to go much higher. We're just going to now work between this let's call it 1 million to 1.3 million as we go through, because the average was a little bit closer to 1.4. We just think it's going to be a little bit lower at this point and closer to about 1.1 to 1.3 and working within those levels. on those highs and lows, which is, again, that seasonal norm. When we look at 2019, that's what normally happens is we now get this little spike, we get higher lows and then higher highs, and then we start to flatline. And that's what we're going to see at this point as we go forward. Now, on the open table side, as we did get some increases in COVID cases and some just delays on just capacity, and then some extended downtime on a global level, that's what set us off and moved us down in general when we look at across the global seeded, coming in at about 41.8% below normal. And here's where we can see what caused that. It was really Canada. So Canada going into a steeper lockdown, you saw that offset the gains that we had in the UK reopening. These are things where Australia remains strong, and then the US is starting to normalize just because things have gotten a little bit colder. So again, that's going to keep people, let's just wait until next week when it's a little bit warmer. So that's something that we'll see a little bit of a recovery from. But again, we still think that on a global level, we're going to be closer to down 28 to 30% across the regional side. It's just we did get a big gain in employment, and we'll talk about this in the Econ show, where restaurants coming back did pull additional people out of unemployment. It's just that we think that that's now going to pause as we start to digest these reopenings in general. And again, it's just going to kind of slow down as we don't really come lower, but we also don't continue to drive higher, which is going to be the kind of that flatlining as we go through the remainder of April and into May.